I want to tell you something that might make you uncomfortable, and I say this not to frighten you, but because I have watched this happen for more than half a century, and I have seen it destroy more wealth than any market crash ever could. The stock market is not dangerous because it falls. It is dangerous because of what it makes you believe about yourself. It is dangerous because it feels safe when it should not, and it whispers promises that sound true until suddenly they are not. And the strangest part is that the people who lose the most money are often the smartest people in the room. They have good jobs and good educations, and they read the right books, and they still walk away with less than they started with. Not because they were unlucky, but because they made a mistake they never even knew they were making. You see, most people think the risk in investing comes from the market itself. They think it comes from recessions or crashes or bad companies or corrupt executives. And those things exist, of course. But the real danger is much quieter than that. It sits in the space between your intentions and your actions. It lives in the moment when you feel certain about something that has not happened yet. It hides in the feeling of being right when the numbers are going your way and in the feeling of panic when they are not. The market does not destroy you with violence. It destroys you with patience. It waits for you to make the same mistake that almost everyone makes, and then it takes your money slowly and steadily over years and decades until you wake up one day and realize that you have been working against yourself the entire time. Let me explain what I mean. Imagine you are 30 years old and you have $10,000 to invest. You open an account and you buy shares in a solid company. Nothing fancy, just a business that makes money year after year. And for the first few months, everything is fine. The stock goes up a little, then it goes down a little, then it goes up again. And you tell yourself that you are in this for the long term. You tell yourself that you understand patience. But then something changes. The stock starts to climb. It goes up 5%, then 10%, then 20%. And suddenly you are checking the price every day. You are reading articles about the company. You are imagining what that $10,000 could become if this keeps going. And it feels good. It feels like you were right. It feels like you are smarter than the people who did not buy. Then one morning you wake up and the stock is down. Not a lot, just a few percent. And you tell yourself, it is fine. It is just a bad day. But then it keeps falling. 5% becomes 10%. 10 becomes 15. And now that feeling of being right is gone. Now you are worried. You start reading different articles. Articles about why the company might be in trouble, about why the stock might go lower. And the more you read, the more reasons you find to be afraid. So you sell. You take your loss and you tell yourself you will buy back in when things are more stable, when you can see the bottom, when you feel certain again. But the bottom never announces itself. The stock keeps falling for a while and you feel relieved that you sold. Then it stops falling. Then it starts to recover, slowly at first, then faster. And you tell yourself you will buy back in soon. But soon never comes because you are waiting for the right moment. You are waiting to feel certain. By the time you feel certain, the stock is already higher than where you sold it. So now you are standing on the sidelines watching the thing you used to own go up without you. And that feeling is worse than any loss. So you look for something else, something new, something that feels like an opportunity, and you find it, a different stock, a different story. And the cycle begins again. This is the mistake, not buying the wrong stock, not selling at the wrong time. Those are just symptoms. The mistake is believing that you can feel your way to the right answer. The mistake is trusting your emotions in a place where emotions are designed to mislead you. The stock market is not built to make you feel good. It is built to make you feel uncertain and then to profit from that uncertainty. And the reason intelligent people lose money is because intelligence does not protect you from fear. It does not protect you from greed. It does not protect you from the need to feel like you are doing something. I have seen this happen to doctors and lawyers and engineers, people who are brilliant in their own fields, people who can solve complex problems and manage difficult projects. But when they enter the stock market, they become someone else. They become emotional. They become impulsive. They start making decisions based on how they feel instead of what they know. And the market does not care how smart you are. It does not care how hard you work. It only cares whether you can sit still and do nothing when doing nothing is the hardest thing in the world. Let me show you what this looks like in numbers, because numbers do not lie. Let us say you invest that $10,000 in a stock that returns 10% per year on average, not every year. Some years it is up 20%, some years it is down 15%, but on average over a long period of time, it returns 10. If you leave that money alone and do nothing for 30 years, that $10,000 becomes $174,000. That is the power of compounding. That is what patience looks like in a portfolio. But here is the problem. Almost nobody leaves it alone. Almost nobody does nothing. Instead, they check the price. They read the news. They feel excited when it goes up and worried when it goes down. And when it goes down enough, they sell. Maybe they sell at a 10% loss, thinking they will avoid a bigger loss. Maybe they sell at break even after it recovers, thinking they dodged a bullet. And maybe they even buy back in later. But every time they do this, they interrupt the compounding. They pay taxes on the gains. They pay fees on the trades. They miss the best days because they were sitting in cash waiting for certainty. And instead of turning 10,000 into 174,000, they turn it into 60,000 or 40,000 or less, not because the market failed them, but because they failed themselves. This is what most people do not understand. The market is not the enemy. Your behavior is the enemy. The market will go up and down. It will scare you and excite you and frustrate you. But over time, it will reward the people who can ignore those feelings. It will reward the people who can sit through the boring years and the painful years and the years when nothing seems to be working. Because those are the years when everyone else is selling. Those are the years when the patient investor is buying what the impatient investor is giving away. I remember sitting in my office years ago during a terrible market. Everything was falling. The news was full of panic and doom. And I received a letter from a man who had invested with me years earlier. He wrote that he was worried. He said he had worked his whole life to save his money and he could not afford to lose it. He wanted to know if he should sell. And I understood his fear. I understood that watching your savings shrink is painful. But I also knew something he did not. I knew that the businesses we owned were still making money. I knew that the value of those businesses had not disappeared just because the stock price had fallen. I knew that the people who were selling because they were afraid, not because something fundamental had changed. And I wrote back to him and told him that if he sold now, he would turn a temporary decline into a permanent loss. I told him that the best thing he could do was nothing. He did not listen. He sold. And a year later, the market had recovered. And 2 years later, it was higher than it had ever been. And he never bought back in because he was waiting for the right moment, waiting for certainty. And certainty never came. He turned a difficult year into a devastating decade because he could not sit still, because he trusted his fear more than he trusted the process. This is the pattern I have watched repeat itself over and over. People buy when they feel good. When the market is up and the news is positive and everyone around them is making money, they buy because they do not want to miss out. They buy because it feels safe. But that is exactly when it is most dangerous. When something has already gone up a lot, it has less room to go up and more room to come down. When everyone agrees that something is a good investment, it is usually because the good news is already priced in. The time to buy is not when you feel certain. The time to buy is when you feel uncertain. When prices are low and sentiment is negative and nobody wants to talk about stocks anymore. But that is also the time when most people are too afraid to act. And then the opposite happens when things get bad. The market falls and the news is terrible and everyone is talking about how much worse it could get. That is when people sell. Not because they have a better place to put their money, but because they cannot stand the feeling of watching it disappear. They sell at the bottom and then they wait for things to improve. And by the time things improve, it is too late. They have already locked in their losses. They have already missed the recovery. And they convince themselves that they are being prudent, that they are protecting themselves. But what they are really doing is protecting their emotions at the expense of their wealth. The truth is that the stock market is not designed for your comfort. It is designed to transfer wealth from the impatient to the patient, from the emotional to the rational, from the people who need to feel like they are doing something to the people who can do nothing and feel fine about it. And this is not a moral judgment. I do not think people who lose money are bad or weak. I think they are human. I think they are reacting the way humans are wired to react. The problem is that the way humans are wired to react is exactly wrong for investing. We are wired to run from danger, to act quickly when we feel threatened, to seek safety in groups, to remember pain more vividly than pleasure. These instincts kept us alive for thousands of years. But in the stock market, they destroy us. In the stock market, danger often looks like safety, and safety often looks like danger. The stock that has fallen 30% feels dangerous, but it might be the safest thing you can buy. The stock that has doubled in a year feels safe, but it might be the most dangerous thing you can own. And your instincts will tell you to do the opposite of what you should do. They will tell you to sell when you should hold, to buy when you should wait, to act when you should do nothing. And this brings me to the core of the problem, the mistake that almost everyone makes, the mistake that quietly destroys more wealth than any crash or recession or bad company. The mistake is this. People think investing is about finding the right stocks or timing the market or predicting the future, but it is not. Investing is about controlling yourself. It is about managing your own psychology. It is about building a process that protects you from your own emotions. And most people never learn this because most people never realize they need to. They think the problem is out there in the market. They think the problem is bad luck or bad timing or bad advice. But the problem is in here, in the space between your ears, in the way you react to fear and greed, in the way you confuse activity with progress and certainty with safety. I have watched people chase the hottest stocks because they did not want to feel left out. I have watched them sell solid businesses because they read a scary headline. I have watched them jump from strategy to strategy looking for the magic formula that will make investing easy. And none of it works. None of it ever works. Because the magic formula is not a formula at all. It is discipline. It is patience. It is the ability to sit with discomfort and do nothing. And that is the hardest thing in the world to do because doing nothing feels like giving up. It feels like you are not trying. It feels like you are letting the market push you around. But in reality, doing nothing is the most powerful thing you can do. It is the thing that separates the winners from the losers over the long term. Think about it this way. If you bought a house and the next day someone offered you 10% less than you paid, would you sell? Of course not. You would tell them the house is worth what you paid for it and they can come back with a better offer. And if they came back a month later and offered you 20% more, would you sell? Maybe. But probably not because you did not buy the house to flip it. You bought it to live in, to build a life in. And the day-to-day fluctuations in what someone might pay for it do not matter because you are not selling, you are holding. But with stocks, people check the price every day. They see it go down 10% and they panic. They see it go up 20% and they get greedy. They treat it like a game instead of a business. And that is the mistake. When you buy a stock, you are buying a piece of a business. You are becoming an owner. And owners do not sell every time the value of their business fluctuates. They hold through the ups and downs. They focus on whether the business is making money and whether it will continue to make money. They ignore the noise and they trust the process. But most people do not think like owners. They think like gamblers. They think like traders. They think the goal is to predict what the price will do tomorrow instead of understanding what the business will do over the next decade. And that is why they lose. The market will always give you reasons to doubt yourself. It will always give you reasons to sell. A bad earnings report, a scandal, a recession, a war, a pandemic. There will always be something. And if you are waiting for a time when there is nothing to worry about, you will never invest. You will sit on the sidelines watching and waiting. And by the time you feel comfortable, it will be too late. The gains will already be gone. The opportunity will have passed. And you will convince yourself that you were being smart, that you were being careful. But what you were really being was afraid. Fear is the most expensive emotion in investing. It costs more than greed. It costs more than overconfidence because fear keeps you out of tea. A market when you should be in, and it pushes you out when you should stay. And the cost of being out of the market during the best days is staggering. If you miss just the 10 best days over a 30-year period, your returns drop by more than half. And those best days almost always come during the worst times. They come right after a crash, right after a panic, right when everyone else has given up. And if you are sitting in cash waiting for things to calm down, you miss them. You miss the recovery, you miss the rebound, and you turn a bad year into a bad decade. This is why I say the stock market is not dangerous because it crashes. It is dangerous because of what it makes you believe about yourself. It makes you believe you can predict the future. It makes you believe you can time your decisions perfectly. It makes you believe that action is better than inaction. And all of those beliefs are wrong. The future is unknowable. Timing is impossible. And most of the time, the best action is no action at all. But that goes against everything we are taught. We are taught to work hard, to solve problems, to take control. And those are good instincts in most areas of life. But in investing, they are poison. The people who do well in the stock market are not the smartest people. They are not the hardest working people. They are the people who can do nothing when everyone else is doing something. They are the people who can hold when everyone else is selling. They are the people who can ignore the noise and stick to a plan even when that plan is boring and uncomfortable and feels like it is not working. They are the people who understand that investing is not about being right all the time. It is about being less wrong than everyone else. It is about avoiding the big mistakes. It is about letting time do the work instead of trying to do it yourself. And the beautiful thing is that this is simple. Not easy, but simple. You do not need to be a genius. You do not need to predict the future. You do not need to find the next big thing. You just need to buy good businesses at reasonable prices and hold them for a long time. You need to ignore the daily fluctuations. You need to resist the urge to act. You need to understand that boring is good, that slow is good, that patience is the most valuable skill you can develop. And if you can do that, if you can sit still and let compounding work in your favor, you will do better than almost everyone else, not because you were smarter or luckier, but because you were more disciplined. So if I could leave you with one thought, it would be this. The stock market will give you every reason to doubt yourself. It will tempt you with easy profits. It will scare you with sudden losses. It will make you feel like you need to do something. But the mistake is believing that feeling. The mistake is acting on it. The mistake is thinking that your emotions are telling you something true about the market when all they are telling you is something true about yourself, that you are human, that you are afraid, that you want to feel certain. And there is nothing wrong with those feelings. But you cannot let them make your decisions. You cannot let them turn a good plan into a bad result. Investing is not about finding the secret. It is about avoiding the mistake. And the mistake is letting your emotions drive your actions. The mistake is confusing motion with progress. The mistake is believing that you can outsmart everyone else when the truth is you just need to avoid outsmarting yourself. Sit still, be patient, trust the process, and let time do what time does best. It rewards the people who wait.